Hi everyone, welcome to today's webinar proudly brought to you by Orient Futures Singapore. We are honored to have our Senior Analyst, Ms. Cao Lu from Shanghai Orient Futures to share with us her views on the outlook for rubber in the second half of 2023. Let's welcome Ms. Cao Lu, please.
Hello everyone. It's a great pleasure for me to share my presentation here. Today we will share with you outlook for rubber in the second half of 2023. From November last year to the beginning of the year's Spring Festival, rubber futures price rebounded from the bottom. On the one hand, short positions near the key level of 12,000 yuan per ton reduced their holdings, triggering a passive increase in price. On the other hand, micro funds began to focus on the domestic demand recovery logic after the relaxation of domestic epidemic prevention policies. After the Spring Festival this year, rubber price weakened again for three main reasons. Firstly, the pace of post-holiday recovery in domestic demand was slow, and the fundamentals remained weak, with sustained pressure on spot price. Secondly, after the previous round of price increase, the price difference between futures and the spot market widened, and post-holiday arbitrage positions increased. Thirdly, in March, overseas micro-bearish factors continue to drive market concerns about economic recession and weakening external demand, leading to an accelerated downward trend in rubber futures price, once again falling below the key level of 12,000 yuan per ton. Since April, rubber price have been hovering at the bottom, with limited upward driving force from the fundamentals. Although there has been disturbance during this period, such as rumors of white mold disease, drought, and rubber storage policy, their impact on the fundamentals has been limited and has had little impact on the trade of rubber price. Since the beginning of this year, the rubber weather conditions in domestic and foreign rubber producing areas have been generally normal. The tapping work started in the second quarter, and production has shown a seasonal decrease trend starting in August. As natural rubber producing regions gradually enter the peak season, global rubber output will be at a high level for the year. Although the turning point in the absolute level of global rubber output capacity has not yet appeared, the significant decline in newly added production capacity in recent years has already constrained the growth space of production. Even under the conditions of high raw material price and relatively normal weather in the main producing countries since 2018, the production level has not shown a significant upward breakthrough. We believe that the current production level has encountered an upward bottleneck due to the growth potential of production capacity and is expected to decline in absolute terms between 2024 and 2027. From the perspective of the growth cycle of rubber trees, global rubber newly added production capacity has passed the phase of accelerated release since 2020. According to the model's prediction, the decline in production capacity is expected to occur between 2024 and 2027, Although the growth of rubber production in major producing countries has been slow or declined in recent years, the production in emerging rubber areas is still growing. Emerging rubber producing areas have a relatively new rubber plantations, mostly with high-yielding tree species, and the cost of tapping rubber is lower than that in May producing countries, resulting in a constantly high growth rate of production. The difference in the release rhythm between new and old producing areas is the main reason why the global potential output of rubber is still at a high level. It is expected that the absolute level of global production capacity will decline between 2024 and 2027. Since 2021, under the global commodity inflation environment, overseas raw material prices have remained high. Since the second half of 2022, the impact of substantial contraction in domestic and overseas demand combined with seasonal growth in supply has led to a significant decline in raw material price in main producing countries. This year, overseas raw material price has remained at the median level of the past few years. At the current price level, rubber farmers are not lacking motivation to tap rubber. Without extreme weather conditions, the rubber output will release normally in the second half of 2023. The inflection point of rubber production capacity may not appear in 2023. However, restricted by the capacity growth potential, even under normal weather conditions, there is an upward bottleneck for rubber output. Seasonally, the global rubber production will be at a high level in the second half of 2023. For the demand side, before the Spring Festival this year, due to the impact of the epidemic, there was a shortage of workers, and the operating rate of tire companies significantly declined. After the Spring Festival, tire factories concentrated on shipments to fulfill previous orders, and with workers gradually returning to work, the operating rate increased rapidly. From the perspective of end demand itself, since the post-holiday period, the demand side has shown a weak recovery trend, with slow shipment rates and significant sales pressure on tire manufacturers, especially in the all-steel tire sector, leading to an increase in finished tire inventory. In the first half of the year, foreign trade orders for tires still provide some support, while the domestic market demand showed weakness. Since the post-holiday period, the progress of domestic demand recovery has been slow, especially in the replacement tire market. In the overseas market, the global shortage of automotive semiconductors has not been fundamentally resolved, although the inventory in the industry chain is slow. Overseas automotive production and sales have not shown significant improvement. In addition, under the backdrop of the Federal Reserve's continuous and substantial interest rate hikes, overseas market demand is beginning to show signs of decline. In the short term, external demand is difficult to improve significantly due to economic recession and the shortage of automotive semiconductors. Since the beginning of the year, domestic rubber spot inventories have continued to accumulate and are currently higher than the same period last year. The progress of domestic demand recovery is below expectations, and the weakening of external demand has led to an influx of overseas goods into the domestic market, resulting in sustained high levels of arrivals at ports. Rubber inventories in the Qingdao area are not being depleted smoothly. In addition, the continuous increase in arbitrage positions has also made global inventories more prominent in China. For the market outlook, from a long-term perspective, the current rubber price is still in the process of verifying the bottom of the cyclical market. Looking at the long cycle, the key factor driving the reversal of the market is still on the supply side. That is, when will the turning point of the production capacity cycle come, which is currently in the verification stage. Before confirming the trade reversal, the market will continue to be dominated by short-term fluctuations in a bull-bear game. Looking ahead to the second half of the year, in terms of supply, with the current low rubber prices, rubber farmers are actively tapping rubber. Under the normal weather conditions, the supply side will release rubber in a normal volume. From a seasonal perspective, starting in August, as global rubber producing regions enter the peak season, output levels will be at their highest for the year. In terms of demand, in the short term, external demand is unlikely to improve significantly due to economic recession and the shortage of automotive semiconductors. The weakening of external demand has also put pressure on the domestic spot market due to the influx of overseas goods. In terms of domestic demand, before the Spring Festival, there was a rebound in the market based on the logic of domestic demand recovery after the relaxation of domestic epidemic prevention policies. However, after the holiday, the market shifted from trading expectations to trading reality. Due to the slower than expected economic recovery, rubber price continued to be under pressure. Without strong micro-policy stimulus, domestic demand may continue to show a weak recovery trend. Overall, in the short term, the rubber fundamentals lack upward driving force, and perhaps only an absolute low price can stimulate effective destocking and rekindle the weakness of funds to go long. Two areas to pay attention to in the future. First, policy aspect, mainly focusing on the implementation of domestic rubber storage policies. Once confirmed, it may have a certain impact on the market. Second, weather conditions. If abnormal weather occurs, it will bring new fresh-oriented market trends. It is important to pay attention to the evolution of El Niño in terms of weather. According to NOAA's forecast, The probability of El Nino occurring from July to September exceeds 94% and expected to gradually strengthen in the northern hemisphere winter of this year. There is an 84% chance of a moderate El Nino event occurring by the end of this year, and approximately a 56% chance of a strong El Nino event. If a strong El Nino occurs, it may have a certain negative impact on the rubber production in main producing countries. This is all about my presentation of the outlook of rubber in the second half of 2023. Thank you all.
Thank you, Ms. Cao Lu, for her valuable insights. Yeah. Now we have gone to our Q&A session. Yeah. So we have two questions for Ms. Cao Lu. The first question, when will the rubber price be able to come out from the bear market cycle?
Okay, from a long-term perspective, the current rubber price is still in the process of verifying the bottom of the cyclical market. Looking at the long cycle, the key factor driving the reversal of the market is still on the supply side. That is, when will the turning point of the production capacity cycle come, which is currently in the verification stage. Before confirming the trade reversal, the market will continue to be dominated by short-term fluctuations in a bull-bear game. According to the model's prediction, the decline in production capacity is expected to occur between 2024 and 2023.
And second question, does the listing of synthetic rubber affect the price of natural rubber?
Okay, the impact of synthetic rubber's introduction to the market on the price of natural rubber is limited. Although both are mainly used in the tire sector, tire companies typically make synthetic rubber and natural rubber to complement each other's properties, with limited substitution ratios between the two. Moreover, the supply-side analysis of synthetic rubber and natural rubber is entirely different. In the long historical perspective, the price difference between synthetic rubber and natural rubber fluctuates significantly, and sometimes even extreme market conditions may occur. Thank you.
Thank you. With that, we've come to the end of our webinar. If you have more questions or you need more information, please feel free to browse through our website at orientfutures.com.sg or send us an email or WhatsApp. Yeah. Thank you, Ms. Cao Lu. And till then, thank you, everyone.